Computing Infrastructures Inc. here to talk about stock price variance. We provide this data to our clients and we also post it on our website. So here to talk you through it. So stock price variance is one way to measure the riskiness of U.S. listed stocks. See, risk is a function of stock price variance, which is the degree of which stock prices vary around their mean change. We have a belief in behavioral finance that risky stocks with high variance require investors to demand a higher expected return to hold them. The high uncertainty presented by higher variance requires that higher expected return. And we calculate this variance based on daily adjusted price changes over the past 253 days. And obviously, a stock that maintains a stable price, or stocks that rise or fall steadily, a little bit every day, let's say, have lower variance than stocks that fluctuate aggressively. So here's what we do is we talk about our research and we talk about it. So here's the information about the stocks. We also have some experimental questions that we share. Let's show them to you right here. The first is, what causes increased stock price variance? We have a lot of ideas. Is there a linkage and possibly a lag between rising stock price variance and falling stock prices? Do we see differences in stock price variance across stock populations? Yes, this is one that we can answer. And fourth, do indices provide significant protection against stock price variance? And we would say yes as well. And we can talk about why. So our observations are, we started measuring in May 2022. The variance of daily prices are elevated and have recently plateaued. Stock price variance is consistently and significantly higher for stocks of companies with negative net income. And those could also be non-U.S. headquarter location companies. So if a company or a stock is of a company that loses money, it tends to have a higher stock price variance. What's interesting is the riskiness of the S&P 500 ETF, index ETF, the SPY. It is elevated, but it is slightly better, meaning lower, than an equally weighted set of all profitable stocks. So we believe it's the benefit of a market capitalization weighted index. Market capitalization weighting provides better risk-return economics, adjusted risk economics. So we believe that the SPDR is providing better variance readings because of that capitalization weighting. Key takeaways. We, or you, can improve the variance of your portfolios by market capitalization weighting analysis and holdings. In our case, there's a data accuracy issue, such as if our data provider has a small mistake in market capitalization, let's say they read the number of shares wrong, then it would cause a data inaccuracy. And we wouldn't necessarily find it because we're using thousands of stocks. It also has a higher computational cost. And so just imagine you having to calculate things with the capitalization weighting. The second is, invest only in profitable companies with U.S. headquarter locations. All things being equal, it gives you less price volatility. And third, we have seen a causal relationship, casual relationship, not causal, casual, between rising stock price variance and falling stock prices. No proof of causality, but there you have it. So for U.S. listed stocks with positive net income, in May 17, it was 1.4 times 10 to the negative 4. 1.4. As you got to August, it was 1.9. September, crossed into 2.0, 2.2. By October, it was reaching 2.3, 2.4. And here we are in December, we're at 2.5. So we're significantly higher and we're consistently higher. It appears we are plateauing in that we went from 2.4 to 2.5 to 2.6 and then back to 2.5. Now, what about stocks with negative net income? It started at 4.3. So it's always been higher than profitable stocks. 4.3 times 10 to the negative 4. in May. By July, you were at 5.5. You stayed about flat. September, you hit 6. By October, you hit 7. By November, you're at 7. By December, you hit 8. And it appears to have dropped to 7.7. So significantly higher. The S&P 500, or the SPDR, the index ETF, was at 1.2. Now that started to rise. So by June, 1.4. By July, 1.6. By August, 1.7. You're noticing it's not as quick of a rise. By September, 1.9. By October, 2.0. And this is where it gets interesting. It hasn't really risen that much. So November, 2.1. All the way up to 2.3. And in December has been flat at 2.3 times 10 to the negative 4. Finally, we started measuring it for the QQQ, or the NASDAQ Composite 100 ETF. And in November, it was 3.8. In December, 4.1. And that was the last time we measured it, was December 15. So 2.3 for the SPDR, 4.1 for the NASDAQ. And that is likely because there are money-losing companies in the NASDAQ. There's high-tech growth stocks that maybe don't have the same earnings power. And also people are expecting the future with QQQ. So that's interesting. QQQ, higher variance, you would expect higher expected returns. If you don't get it, though, you could be pretty nervous. So let's talk about how you find this data. So this is our up run. All stock variance for our up run is 2.5 times 10 to the negative 4. It's for 1,656 stocks. And that 2.5 compares pretty favorably to the S&P 500, which is at 2.3 times 10 to the negative 4. You also see actual returns. So the QQQ has lost 33% in the past year, not including dividend pays, which is about 1%. The Russell lost 21, and the SPDR lost 19. So the SPDR lost 19, the QQQ lost 33, and that's obviously with a much higher riskiness in the QQQ. Let's take a look at money losers. The money losers have a 7.7 times 10 to the negative 4 variance on 643 stocks, and again showing an S&P 500 variance of a 2.3 times 10 to the negative 4. So money losing stocks have a significantly higher variance than the S&P 500 or stocks that made money. And so if you were to buy our service every day by a run, you would get this data before market open. And in fact, what you would get is you would get a list of comparable stock prices and stock information and all this data, and you would have it, and you would have a variance versus average close that is normalized. So you can sort that by descending order, and you can look for profitable stocks with tremendous variance, because obviously those are going to be ones that move. And on a day like today, most likely moving up. So we know stocks like Silvergate are up tremendously today, Upstart, Coinbase, because they have very, very high variance. But you would look at others that maybe don't kind of, jump out at you, right? Newegg Commerce, Siga Technologies, which does COVID tests and flu tests, Unisys, 1-800-Flowers, right? So there's other companies that have a tremendously high variance, and you might not expect those as common names. Unlike kind of you're in the biz and you know that Upstart, Coinbase, and Silvergate are going to be crazy volatile. So, and today I think Silvergate was up 25%. So it's kind of nice to have it. And if you buy the up run, you get this, and you can look at other things as well, such as volume fluctuations. 480% of the volume of average volume over the past year. And you can see Silvergate has been trading high. People might have been taking positions in Silvergate and in Verizon and in Walt Disney, waiting for the action today, right? So they buy yesterday, they trade yesterday to get positioned, so that today they can drive it home. So thank you very much for watching. Again, just to quickly summarize, stock price variance. We have a whole bit of research on it. We're sharing it on our website. And you get this data every day on all the stocks that we analyze comparable. In addition, you can just look here for some summary information. Thanks very much for watching. Hope you found this helpful. Bye-bye.